Hello and welcome to this course on personal financial planning. This subject is known by different names. Of course, one of the names is what we titled here, personal financial planning. A lot of people refer to this as financial planning, whereas some others refer to this entire subject as personal finance. But in a nutshell, what this course is all about, or what the subject is all about, is financial planning. And within financial planning, we are going to look at the personal side of financial planning, which means we are not referring to the corporate or institutional financial planning. We are only going to talk about what matters to individuals and families. With that, let's start the first session. It's an introduction to this subject. And as I mentioned earlier, we've changed the title from personal financial planning to financial planning. So we'll keep interchangeably using all the three titles. In this particular session, we are going to talk about three things. First of all, why this subject is needed, what is the concept of financial planning, and the scope that it covers. We'll also look at the basic defined steps, also known as the financial planning process. And in this particular session, we'll touch upon the regulatory angle. More about introduction, while we'll cover the regulations sometime later during this course. In order to understand this subject, let's start with some cases that you see around us. These are real life cases. Of course, the names and some of the other details have been modified to protect the identity of these people. But these are cases that anybody would be able to relate to. The first case is about a corporate executive, a young 30-year-old, good job, nice package. The company also offered various benefits, including life insurance and health insurance. And when a health insurance policy is offered by a company, it often means that the executives do not buy a separate policy on their own. Now, at a young age, when one has joined the corporate world, one feels that one is going to stay in this job for a long period, and to that extent, there may not be a need for buying a separate health insurance policy. That's understandable. The problem happens when one loses job or one takes a break in between jobs. If something happens during that period when one is unemployed, at that time there is no income in form of salary, the increased expenses because of the medical situation, and in the absence of a health cover, it can actually lead to financial trouble. But it's not just about not having a job at that point in time. Even if one switches over from one job to the other, many policies come with a cool off period or wait period, and this wait period is especially pertaining to certain pre-existing conditions. The wait period could also be about maternity related expenses. And in such a situation, when one changes the job, even without taking a single day's break, the policy automatically gets deferred, some of the benefits at least. And to that extent, for that wait period, one could be without any cover. Case number 2. Many wealthy people, and especially in these times, you see, when a lady has lost her husband, it could happen to a widower also, but in this particular case, it was a widow. And kids are settled far away from where the parent is living. This 55-year-old wealthy widow had enough money, actually more than enough, to take care of all her requirements. Enough investments, cash flow also planned through various sources of passive income, and she also had this decent amount of liquid cash in the bank account. But when she was in coma for 15 days, the question is, who would sign the documents to access the money, withdraw money from the investments, or withdraw money from the bank to make the payment to the hospital? A doctor couple, middle-aged, the daughter was, doing very well in her school. They wanted to send her abroad for higher education. And that's a dream of a lot of parents. And they had accumulated enough wealth for this purpose. Now, as we can see here, the wealth, accumulated wealth, was more than 20 times the first year fee that they had to pay for the daughter's education. And that's more than enough to fund the education, of course. However, one detail is important. It was entirely real estate and there were no other investments. No other investment means there is a problem of illiquidity. This portfolio cannot be easily liquidated. Easily. It's not that this cannot be liquidated. Now let's say that suppose the daughter needed 20 lakhs, or the fees for the first year was 20 lakhs. And as you mentioned, the portfolio's value was more than 20 times. Right? So 20 times of this is around 4 crore. I'm just taking hypothetical numbers. 4 crore worth of real estate portfolio. And let's assume that this was divided into 4 properties of 1 crore each. Now you see the point. In order to make a payment of 20 lakhs, one has to sell one property of 1 crore rupees. And that means the transaction costs would be applicable to this 1 crore. The capital gains arising out of the sale of property has to be separately calculated and paid. And once this 20 lakh fee is paid out and the taxes and transaction costs are paid out, whatever is the remainder, if that remainder is also to be invested in real estate, there will be additional costs. So this particular situation was that the doctor couple had enough wealth, but they were liquidity poor. all of us probably remember the global financial crisis of 2008. The crisis started sometime in 2007, but the real impact was felt sometime in October of 2008 when Lehman Brothers filed for bankruptcy protection. The Indian markets, and I'm talking about the stock markets in particular, started feeling the heat sometime in January 2008. From the peak levels, it started falling. This particular corporate executive had planned an early retirement and he had accumulated what he considered was enough for funding his retirement. January 2008, he left the job, and then a lot of wealth was in stocks or equity mutual funds, and when the market started coming down, the wealth also started depleting. Now just imagine, I'm just putting some numbers. Sensex at peak was around 21,000, and around 8 to 9 months later, it was around 10,000 points. A drop of this magnitude also means that wealth also commensurately dropped. So if in January 2008, this person had sufficient money to take care of next 25 years of expenses, by October 2008 or December 2008, this entire cover was roughly 13 or 14 years worth of expenses, if I'm assuming that everything was invested in Sensex. You don't expect tragedy to strike, and you never know when exactly would that happen. A lot of youngsters start acquiring what looks to be the status symbols. So this is another case. A young executive, 30-year-old, he had a 3 BHK flat, the place of primary residence, owned flat. Also a holiday home, and the couple had taken 2 SUVs. So these are the items that you can show off. There's nothing wrong with that, by the way. However, these are all assets that you possess. And if these assets are bought through loans, the difference between the two, which is net worth, is much smaller than assets if the loans are reasonably high. And by the way, this net worth is an indicator of the wealth that a family has. Let's remember, there is nothing wrong in acquiring assets. However, if the liabilities go out of hand, the net worth remains low. A little bit of leverage also is not wrong. Too much of it can really be harmful. And we'll look at some of the ratios sometime later when we come to the situation analysis. Now you may wonder that why are we only talking about negatives. Well, it's not just about negatives, but there are dreams that people have. And one such young software executive, software engineer, had a dream of starting his own startup. Now, when you have such a dream, when you have a business idea in mind, you may need money to fund that project. You need funds. And these funds also can be accumulated through a proper process of financial planning. In short, this entire topic, the entire subject of personal financial planning is not really so much about money. It is about the way we want to live our life. Think about it for a moment. In each of the previous situations, money came in the discussion later. First, it was the life situation. If planned properly, we can live the life of our choice. If not planned properly, if mistakes are made, then financial life can be jeopardized. And that really is the essence of personal financial planning. There are many misconceptions about the whole subject of financial planning, and I would like to start with what it is not. A lot of myths prevail. So first of all, financial planning is not equal to tax planning. Many times we hear that, I've gone to my chartered accountant, he has suggested investments and insurance, so my tax planning is done. So my financial planning is done. Number two, some people think that they have identified their long-term financial goals, and to fund those goals, they have started SIPs in mutual funds. Their financial planning is done. Some of the people say, I bought the insurance policies for various purposes. If something happens to me, my family is taken care of. And otherwise, all these policies will help you fund my dream life or my long-term goals. In isolation, tax planning is not financial planning, investment planning is not financial planning, and insurance planning is not financial planning. Having said that, all three are components of financial planning. These are not in essentials, but they are parts of the whole.